impact could this have in terms of our oil trade, and what is happening with the global oil prices right now? Let's understand a little bit more about that with Mr. Probal Sen, VP Equity Research at ICICI Securities, joining us on the show. And Probal, hi, morning. Thanks for your time. First up, let's talk about oil prices. Largely unchanged after the additional 25% announcement that we've seen last night. Help us understand what really is the oil market pricing in at this point. What assumptions do you think could be at play here, and what levels are you spotting for Brent as of
now? Excellent questions. I wish I had clear, definitive answers to any of those. I think let's put the numbers in perspective. All said and done, Russia still exports at last count close to about 4.7 million barrels of oil per day. They produce obviously much more, but they have some internal consumption as well. Their seaborne exports are in that range of around 4.7 million barrels. At one point of time, India was actually importing close to 2 million barrels a day of that, with most of the balance going to China. So last year, our understanding was that this crude was available to us at basically anywhere between $4 to $5 discounts to benchmark. Now, on the face of it, with the new sanctions that the EU has put in place, this price should actually go down. But I think as the flash is coming through on your channel, there is an additional cost that is coming through for logistics, for insurance, for arranging vessels, for freight, everything else gets costlier because of the compliance with sanctions. So effectively speaking, the amount we can actually import itself has actually reduced. Some reports indicate July 25, we actually imported about 1.5 million barrels. That is already way down from the 2 million barrel a day number that I mentioned, which was there last year. Now, in terms of global, impact, the fact is that replacing 4.7 million barrels of oil per day from the global supplies is not really something that is going to be easy. What your attempt is basically is to make it costlier to do trade with Russia and reduce the netbacks that they're getting from these exports. So obviously, the kind of supply uncertainty that comes through, if people actually see those flows getting impacted, then obviously prices can actually escalate very, very sharply. The reason perhaps prices haven't moved all that much is, one, OPEC at the same time is unwinding most of its 2 million barrel a day supply cuts that they had put in place for a long time. And two, I think there is probably a belief that these barrels will probably get more difficult to export and, sort of the flows might become costlier, but not that these supplies would actually completely go out of the global trade system altogether. So that, plus the fact that demand obviously is not really growing as much as probably people would like. I think estimates are varied for CY25. IEA on the one hand, OPEC has a much more optimistic 1 million barrel a day plus kind of an estimate. So demand is uncertain, supply can be a little bit constrained, but as of now, I think people are looking in a wait and watch mode before taking a call on where prices will move. For India, definitely it's a negative from both supply certainty as well as the cost of those supplies, both becoming more adverse than they were earlier.
So let's get specific here, Prabal. What will the impact on OMCs be in both cases, right? Either we buy from Russia or we don't buy oil from Russia and find another alternative.
So if we continue to buy from Russia, our understanding is that while there is still maybe a little bit of a discount that's still there with respect to benchmarks, that now level of discount has come off quite a bit. So to do a very simple math, if you're, let's say, buying 25% of your requirements from Russia and you get a discount of, let's say, $5 versus benchmark, that's a straight $1.25 per barrel addition to your GRM. If that discount actually comes down to, let's say, $1, that's just about a 25-cent advantage. So that's the clear impact that will be there if this crude continues to flow. If you do not get any of this crude and you have to sort of resort to alternate sources of crude at this point of time, obviously, again, that same math applies that at this point of time or at your peak, you were taking as much as 40% of your requirements from Russia, at a discount of somewhere around, let's say, $4 to $5. So that was giving you an additional $2 a barrel in terms of GRMs. That GRM advantage basically goes away. On top of it, Singapore GRMs have already softened to less than $3 in recent weeks, and they're averaging about $2 lower at this point of time. If I take July average or August, till date versus Q1. So in any case, I think the earnings situation in the near term would look a little bit more vulnerable.
All right, but Prabal, what is the worst case scenario then, both for India and for the listed energy universe? If you can help us understand that, the worst case for OMCs and oil refiners as well.
Honestly, the worst case is obviously that these flows get restricted and there are near-term constraints on arranging crude in the first place from alternate sources. But frankly, I think it's a very unlikely scenario. That's, at least in my limited experience, that's not the way global trade works. So I would say that, the worst case is that the costs basically go up, as I mentioned, by maybe a couple of dollars, and therefore GRMs remain under pressure. I would not, see anything other than that really playing out. I mean, obviously one can't predict. There are multiple wars, multiple conflicts going on in several parts of the world, and US has been fairly unpredictable, but in terms of its decisions. But I don't think the flows will get disrupted beyond basically an increase in the cost.
All right, but along with that, now, like with OPEC plus, oversupply supersede the impact of the Russian supply being out of the global supply equation. Will oil prices fall in that case then, or the other threat that Donald Trump is coming out with, that similar sanctions could be on the other nations who are rather importing oil from Russia, will it take the oil prices higher, if at all that take place?
I think the oil prices will basically go higher, as I mentioned, if on the ground you actually see supplies basically being reduced from Russia's side, where you basically, people who track the data in terms of shipping data and flow data and so on, if you actually see the supplies actually going out of the system, which you will basically, I mean, it's not something that will be invisible. You will start to see actual impact on the ground in terms of refinery runs, in terms of availability of crude and so on and so forth. I think you will probably see a much more bullish reaction then. At this point of time, based on news events, based on pronouncements, based on intent, as I said earlier, I think people are still probably waiting and watching to see where this actually how all of this actually plays out on the ground, and whether this really has an impact on flows coming out of Russia. So I still think that, you may not see a huge, a spike in crude prices, but I wouldn't advocate for any softness either. I think you're probably likely to see a $70 to $75 range at this point of time, and then a definitive move either way, depending on how all of this plays out over the next couple of months.
All right, Prabal, with this we let you go. Thank you so much for taking the time out and speaking with us.